You thought the real risk to your portfolio was a cooling labor market? But this week, the bigger macro shock came from energy. U.S. crude settled at $90.90 on Friday, and Brent closed at $92.69, as the war around Iran severely disrupted flows through the Strait of Hormuz, a route that handles about a fifth of global oil and LNG trade. That supply shock landed on top of a weak U.S. jobs report and revived stagflation fears across the market. On the domestic side, the U.S. economy lost 92,000 jobs in February. The unemployment rate edged up to 4.4%, and average hourly earnings still rose 3.8% year over year. Leisure and hospitality alone lost 27,000 jobs. That is not a clean bad news is good news setup for equities. It is softer growth with wage pressure still alive. That is why the Federal Reserve's position looks more complicated, not easier. Markets are pricing an overwhelming chance that the Fed holds rates steady at its March 17 to 18 meeting, with rate cut odds for this month still around 3% or less. The labor market is weakening, but higher oil prices are reviving inflation risk at exactly the wrong time. Financing stress is still part of the story, but it needs to be phrased carefully. The benchmark 30-year fixed mortgage averaged 6.0% this week, according to Freddie Mac, while widely quoted 30-year refinance averages were around 6.53%. That keeps pressure on housing, refinancing activity, and any company that still has debt to roll over at higher yields. That backdrop helps explain Friday's market action. The S&P 500 fell 1.3%, while energy and consumer staples were the only sectors to post small gains. Fuel-intensive businesses, especially airlines and transport operators, are exposed if oil stays elevated. U.S. airline stocks have already come under pressure, and Reuters notes that major carriers no longer hedge fuel the way they once did. If you want the cleanest dashboard for the next session, watch three numbers: crude, the 10-year Treasury yield, and U.S. gasoline prices. On Friday, the 10-year yield finished near 4.14%, while the national average gasoline price climbed to about $3.32 a gallon, up sharply from a week earlier. Those numbers will tell you whether this remains an energy scare or becomes a broader margin squeeze on the American consumer. This isn't financial advice. Keep your eyes on the margins. I'm Wilson, and I'll see you tomorrow.